BP's share price has had a 24% increase over the past week following the announcement of the successful COVID vaccine trials. However, their share price is still down by almost 50% from its 2019 high. With the price still in value territory, is it better to buy the stock now before it's too late? Well, join us for a review of BP on today's Investment Store. Welcome to the Investment Store, the personal finance channel that reviews a diverse range of investment asset classes from stocks and ETFs through to real estate and cryptocurrencies. If you enjoyed this video, please click the like button and leave a comment. And if you like our content, then please subscribe to the channel to become part of the Investment Store community and hit the notification bell to ensure that you never miss an episode. With that said, let's commence with today's video. BP is a British multinational oil and gas company headquartered in London. They are one of the 7 oil and gas super majors along with companies like Shell, Chevron, Eni, ExxonMobil, Total and ConocoPhillips. BP is a vertically integrated oil and gas company that explores for, produces and refines oil products around the world. In 2019, BP produced 2.3 million barrels of liquids, 9.5 billion cubic feet of natural gas per day, and operate up to 18,000 gas stations across the world. BP also has a 20% stake in Rosneft, the Russian oil giant that's partially owned by the Russian government. In February 2020, BP appointed Bernard Looney as its new CEO. Looney has set out a new corporate strategy which aims to transform BP from an integrated oil company or IOC into an integrated energy company or IEC. There are 3 main areas of the new strategy, namely integrated energy systems, which is about improving their value chain to optimize energy systems, partnering with countries, industries and cities to help achieve their target of becoming a net zero energy producer, and finally, digital and innovation to improve operational efficiencies and support revenue generation and growth. Now we'll take a closer look at this in our 4-step stock analysis process. At the Investment Store, we take a 4-step approach to analysing stocks. We first look at the economic moat of a business, where we analyse whether a company has any form of economic moat that gives it a competitive advantage. Next, we assess the organisation's financials by taking a closer look at their financial statements and key investment ratios. We then compare the stock with other companies and investment funds in the sector to assess how they're performing within their market. And finally, we calculate the intrinsic value of the stock to see whether it's trading below its fair value. Once we've completed our 4 steps, we will take the ISS score for the stock. Now with that said, let's start with today's analysis. Looking at the economic moat of the BP business first. As mentioned earlier, BP intends to transition from an IOC to an IEC over the next few years. And as part of this strategy, BP has overhauled its business model by moving its traditional upstream and downstream structure and establishing a 4-step approach. With this strategy, they intend to become a net zero producer by 2030 and a leaner, greener and more profitable company. BP's new strategy will largely depend on how efficient they are at generating profits at sub $50 per barrel levels. However, the strategy is showing slight signs of improving efficiency for the business. So for this reason, we score BP a 7 out of 10 for intangible aspect. Moving on to switching costs. BP's refining capacity is 30% lower than its 2010 levels. BP also has large marketing, retail and lubricant operations. Whilst these businesses might not be able to carve out a moat individually, given their lack of competitive advantage, BP's integrated model provides it with expansive value chain across its upstream, downstream and manufacturing businesses, which provides them with an economic advantage in emerging markets such as Mexico, China and India. BP is also regarded to be weaker in petrochemicals amongst its peers, with tax contributions less than 5% on average to downstream earnings over the past 5 years. Therefore, we score switching costs 6 out of 10. In terms of cost leader, BP is still paying back fines of $23 billion for for the Deepwater Horizon incident from 2010, which it needs to complete paying over the next 17 years. They're also aiming to position themselves to remain competitive in a world of low oil prices. To address this, the company aimed to improve their cost structure, reduce its capital outlays, and achieve a break-even level to continue at a $50 per barrel mark by 2021. BP has reportedly achieved reductions of $7 billion or 20% from its 2014 levels, primarily in its upstream segment, where it reduced its workforce by a third. The company is also generally regarded as one of the lowest cost supermajor producers, so we score them an 8 out of 10 for cost leader. When we look at network effect, BP owns 20% of Rosneft, which is government-owned and holds relatively low-cost reserves in Russia. Whilst returns on capital will remain relatively low at 9% over the next 5 years, they should continue to improve over time as the newer, higher margin, less capital-intensive projects become a larger proportion of the portfolio. BP's 20% interest in Rosneft does come with sovereign risk, as they could lose a large stake of their business if the Russian government defaults on its debts. However, we think this is unlikely, so we score network effect a 7 out of 10. Finally, in terms of scalability, BP's new CEO has laid out a new strategy for the next 10 years as they aim to transform the company. The strategy will involve less investment in traditional oil and gas businesses and increasing investment in low carbon energy and digital technology. The strategic goal is that by 2030, nearly 1/3 of capital employed will be in low carbon activities such as electricity generation and other transition businesses, compared to only a fraction of that today. This strategy is, of course, yet to be proven, so we score this a 7 out of 10. This gives BP an overall Moat score of 7 out of 10. Next, we'll move on to the fundamental analysis for BP. Looking first at the revenue and net income, BP announced their Q3 results at the end of October, where they reported a $300 million loss for the period. This was better than expected, especially when considering that the Q2 loss was $6.7 billion. Having said that, the company has still reported a $22 billion loss for the first 9 months of 2020. If we look at BP's performance prior to 2020, we can see that the company achieved solid sales and margin growth between 2016 and 2018. And for this reason, we score BP a 6 out of 10 for revenue and net income. Moving on to net margin, BP's net margin has failed to reach 5% in the past 5 years, which is below our requirements, so we score this a 2 out of 10. BP's return on asset falls below our threshold of 10% and has only gone above 5% once in the past 5 years, which is below our requirements again, so we score this a 3 out of 10. In terms of return on capital employed, or ROCE, BP's ROCE also falls below our threshold of 15%, so again we've scored this a 3 out of 10. BP's debt to equity has remained above our threshold of 1.5 for the past 5 years. It has also been increasing gradually, as you can see, from 1.8 to 2.17 in 2020. So we score this a 4 out of 10. And finally, when we look at the free cash flow yield, which we like using because it's an indication of undervalued stocks, we also noticed that BP have maintained a decent free cash flow yield, which was increasing year on year prior to 2020. Their Q3 free cash flow yield was also up to 3%, so we score this a 7 out of 10. So for fundamental analysis, we've given BP a score of 4 out of 10. We'll now compare BP with some of the other super majors and also the SPDR Energy Select ETF, which is one of the leading ETFs in the oil and gas sector. Cautionary note with this comparison is that US companies follow different accounting rules, which can make comparisons inconclusive. Therefore, it's always worth taking time to do some extra research and crunch the numbers to make them as equal as possible. Firstly, we noticed that BP has the second lowest price to earnings ratio of 11.46. This is significantly higher than Shell, who we analysed a few months ago, but still reasonable on a comparative basis, so we score this a 7 out of 10. Moving on to the current ratio, BP's proportion of current assets to current liabilities is higher than 2 of its super major peers. This is mid-range, so we score this a 5 out of 10. Looking next at the dividend yield, BP has cut its dividend by 50% this year, but it still remains in the mid-range when compared to its peers, so again we score this a 5 out of 10. For earnings per share, BP's is the second lowest in the sector, so we score this a 2 out of 10. And when we move to ROCE, BP's ROCE in 2019 was actually in the mid-range for the sector, which is a surprise considering it has had a relatively weak ROCE over the past 5 years. For this reason, we've scored them a 5 out of 10. BP's price to book ratio is below 1 and is the second lowest in the sector, which indicates that the stock may be undervalued. So we've scored this an 8 out of 10. BP has the highest debt to equity ratio when compared to its peers. So we score this a 2 out of 10. And BP's free cash flow yield is currently one of the highest in the sector, which is good. And for this reason, we score them a 7 out of 10 for free cash flow yield. Finally, BP's share price is currently down 48% on its 2019 average. This isn't the biggest drop in the sector, which indicates that other companies in the sector stand to make a bigger price recovery if oil prices start increasing. So we score this a 6 out of 10. Taking all of this into consideration, we have given BP a comparison score of 5 out of 10 when compared to other oil super majors. The final step in our analysis is to determine the intrinsic value of the stock. At the investment store, we use a discounted cash flow method and Gordon growth model to estimate the value of an investment based on a company's future cash flows. Using an annual growth rate of 5%, we calculate an intrinsic share price value for BP of 159 pence. Taking a conservative approach and using a 1% annual growth rate as the company stands to make a loss during 2020, we calculate an intrinsic value of 133 pence per share. Now, at the time of preparing this video, BP's share price stands at 236 pence, which is significantly higher than both of the values that we've calculated thus far. For BP to have an intrinsic value that reflects its current share price, it would need to have an annual growth rate of approximately 12%. Now, this growth rate was achieved and in fact was bettered in 2017 and 2018, so it is probable, particularly when we consider how badly their 2020 earnings have been affected by the global pandemic. However, we believe that there is still better value with other oil companies in the sector. And so with this in mind, we have given BP an intrinsic value score of 4 out of 10. So to recap, BP has recorded the following scores in each area of our analysis. This gives them an ISS score of 5 out of 10. This is a mediocre score, which indicates that there are currently better investments in the oil and gas sector. As with our reviews of Shell and Exxon, BP's fortunes are closely correlated to oil price. So an investment on this stock largely depends on the market performance of oil. Should we witness an increase in global oil demand, it is likely that we will start to see an increase in the revenue and share price of most oil stocks, with BP being no exception. Now, if we choose to invest in this stock, it would be wise to pay close attention to BP's debt levels. It would also be worth analysing the Q4 results to check whether their new strategy is working. From our perspective, at this stage, it's too early to tell. Thanks for watching. If you enjoyed this video, please leave a like and let us know what you think of our findings. If you'd like to learn more about how we analyse assets, please subscribe to the channel. We look forward to seeing you on the next video.